This is a bubble. By the way, Sam Altman came out this week and called it a bubble. Literally, the tip of the spear in the bubble is calling it a bubble.
Hello, OpEx, my old friend. I've seen the VIX spiking again, without the Qs slowly creeping down. That's all I got.
What I love about that song, and first of all, 67, we've been talking about the similarities between the 60s and 70s, but that song's about people basically not listening, not talking to each other, not listening to the truth. It's all about narrative, cultural emptiness, people talking past each other. That just rings, I feel like it rings so true for where we are. And that's probably not a coincidence, given we've talked about the populism and everything that I think this is apropos for today in the discussion.
When everybody's prepared. And sure enough, today I was seeing that there was a ton of volume going off on super far out of the money puts on the Qs. And I'm like, we're not going to drop then if everybody's immediately running for those puts once more.
I'll add to that too. I think it's important because you connected the meme thing, but those things connect, right? When the vol is this compressed, we've talked about this, but dispersion happens, right? The vol is being compressed at the index level. And this is part of why we, at the Summer of George, which we've talked about on here, beginning of Summer George last year and this year, we were very clear. One of the things that goes with that is the running of the memes. The running of the memes happens because the index gets compressed and everything has to move away from each other. And in the summer, guess what? Hedge funds are short the memes because they're nothing burgers. In the long run, they will go to zero. But whether they go to 10,000 times that price before they go to zero is another story. And so in a low liquidity environment with large long short equity exposure at hedge funds, all compression, forced dispersion away from each other, what happens? You have the greatest degrossing event since COVID. That's what happened this summer. Hedge funds degrossed at the same size and scale that they did during COVID. That's what happened this summer. So, and that was driven primarily by the confluence of a massive growth in long-short equity exposure, while structural product issuance has also dramatically grown, and a low-volume summer where the vol just gets compressed on the index level, pushes everything away from each other. That pain starts in long short. It's too big for the market. And that degrossing then drives it even further away from it. And then guess what? Retail gets in the game and starts squeezing. Not that they understand necessarily all that, but that's the flows that structurally drove the majority of this summer's rally. So the two things are connected. The running of the memes and the vol compression and Gary that you're talking about are intrinsically.
Yeah, sometimes just as a trader, when I'm doing particularly well, like I have been this summer, I have to stop and second guess myself and go, okay, am I doing well, or is this just a product of it being kind of like throwing a dart at whatever and just getting lucky because of this dispersion going on, Yeah,
I mean, it's a narrative, which is what is the easiest game to play, right? It's like a momentum story. Works incredibly well in low liquidity vol compression.
Yeah,
that's the story. And so when all of it, which is the majority of the time, when liquidity comes back and vol is not as compressed, which is rare, that starts to mean revert. And I think as long as you got your environment right, bon ton roulé, let the good times roll.
Man, we're speaking French on here, gang.
Oui.
Parlez-vous gamma?
But people are moving away because they realize we're at all-time records in valuation by many metrics above 2000 in the tech bubble, which, by the way, I started my business, my time in the industry in 98. If you told me right now, like in 2001, 2, 3, that we would see those kind of valuations again in my lifetime, I would call you insane. Mm-hmm. Not that we wouldn't see bubbles somewhere, but the whole market being at those valuations again. I mean, the amount of pain tech bubble was NASDAQ lost 92% of its value from peak to trough. Jesus. And 98% of tech startups went bankrupt.
I can't imagine that happening again today. It feels like the world would be over.
It will. You can show this video when it happens, and the haters will find a way to hate still. It's going to happen. You don't trade at these types of valuations. This is a bubble. By the way, Sam Altman came out this week and called it a bubble. Literally, the tip of the spear in the bubble is calling it a bubble. That doesn't mean it's not going up in the short term. I want to be clear. It was the tech bubble was a bubble in 98 and it rallied for a year and a half and doubled before it lost 92% of its value. Question is, how far will the bubble go? And that's not a function of, that's the voting machine, not the weighing machine. And I think people get confused between those two things. Predicting the next week and next month has nothing, literally nothing to do with the long-term outcome.
I just want to make sure I do this as often as I can because the reinforcement helps me. But the structured products that you talk about, that these hedge funds are engaged in, that these institutions, market makers, dealers, all kind of synonymous, basically in an environment where there is little yield to be little profit to be gotten elsewhere, they've basically found this avenue of like, hey, we figured out that we can sell these structured products, which are essentially selling options on the S&P, on the VIX, you name it. And just in a really dumbed down way, it creates this buoy effect in the market that just kind of, it's a perpetual, just kind of always keeping it afloat because there's always this underlying bid from those structured products, whether they're short options or whatever it is. When they eventually have to cover them, it's just creating, and there's billions of dollars doing this, that's kind of keeping it afloat. Is that let me
clean that up a little bit. You're largely correct, but let me clean it up just to be very clear. First of all, who are issuing and who are buying these structured products? They're not actually hedge funds that are buying them or issuing them. Hedge funds are a separate thing. Banks primarily are issuing them, and they're just structured options positions. It's a way from taking an options position, which is complicated to people, right? And just telling people, I'll give you this payout. If X happens or Y happens, then you make X. If not, you make Z. That's basically what they're selling. It's a structured payout. They're selling a structured payout. And these are growing dramatically in popularity. And I'll get to kind of the why. But who's buying them? Primarily RIAs, meaning entities who are investing on behalf of individuals and other institutions. They are buying these on their behalf. Why do banks do this? Because it's very profitable. They charge really high fees and they take little to no risk. They'll go hedge it out in the real options market. So when a bank does this, issues this, they get long the other side of this trade, and then they have to hedge out their risk because they don't want to hold that risk. And so they go push it. That's what a structured product is. Now, we could spend hours here just going through all the different structured products, how they work, and what they're, and it's not worth it right now. But understand that overwhelmingly, these structured products are focused on the indexes. There are some, in increasing growing amounts, that are on single list options and baskets or pairs, et cetera. Those are getting more popular. But overwhelmingly, these structured products are tied to the indexes, primarily the S&P 500. And overwhelmingly, these structured products do two things. One, they sell vol. Why? Because there's a risk premium to vol. And over the long run, you make money by selling vol as long as it's contained and defined in X or Y. Also, overwhelmingly, they are net long a buyer of some type of skew or convexity on the downside, some protection to sell that vol. So they are skew enhancing, they push skew up, and they sell vol. Not all of them, but over the whole, that is the effect. And that makes sense, right? Because of the short term, the market's a voting machine. How many buyers versus sellers are there? And the long term, it's a weighing machine, meaning valuations, et cetera. Eventually, by the way, how do those two things converge? Because at some point, the voting machine and the weighing machine have to converge. They converge when that weighing machine, right, meaning the valuation of things and whether that's worth buying or not, and to the extent that drives supply and demand, or supply and demand is such that there's not enough liquidity, and all that matters is how much money does a company make? Can they support their own growth? Given the analogy here many times, but I think it's the best one out there. It's the path of an airplane is determined by the amount of fuel in the tank. It's not determined by how far off the ground we are until you run out of fuel. And if you want to know how the voting machine and the weighing machine converge, eventually you wait long enough. It's not a smooth path, but you wait long enough, eventually that fuel runs out. Predicting when and how that fuel runs out is important. But when it runs out, all that matters is how far off the ground you are. And so fundamentals converge when liquidity dries up. And again, think about the SPACs. Think about tech bubble is a great example. We were just talking about it, right? Did it matter where the valuations were in 98? No, it didn't. All it mattered is how much fuel was there in the tank? And there was a lot of fuel, and there was a lot of squeezing to be done because institutions were short in 98, just like now. Retail had a ton of money in their pockets. We were in a surplus. A lot of liquidity was being created. The narrative was there. We were in peace, irrational exuberance. Call it whatever you want. But realistically, the Fed was stimulating lowering interest rates to historic levels relative to where they had been. There was more liquidity due to the amount of money flowing around. And that drove the plane to not 30,000 feet, not 40,000 feet, to 60,000 feet. And then guess what? But the engine ran out of gas. And then it dropped 92% in the NASDAQ. So my point is, we could talk about how far off the ground we are, but talking about how far off the ground we are as a context for predicting where the plane is going is a fool's errand.
Do you have any kind of update on what your crystal ball says? Because VIX expiration is tomorrow. We had the SPX expiration on this last week. What are you thinking? What are you seeing?
In 52 weeks in the year, this is either number one or number two for the most dangerous week. And that's true historically, but it's also true increasingly because of the issuance of structured products and hedge fund positioning and what's happened this summer.
Those keep going up.
So yeah, but that's this week. We're not talking about this month or next 3 months or 6 months or 9 months, right? And so if you say, Jem, what's people have been asking me this last several days, what are the most highest odds for the next week or two? What are the highest odds for the next 3 or 4 or 5 weeks? The answer is 60-40. Odds are we go down. I don't think it's a vol event. I think that's a low probability that we get some big vol explosion. Market down, vol down would be the most likely path. But to be clear, what does that mean? That means, in the next 2 to 3 weeks, read 6%, all right? And if we go down 3 to 6% in the next 2 to 3 weeks, especially on the long, 4 to 6% side, maybe a little bit on the higher side, 4 to 7%, you're more likely to then activate this significant risk that exists on the put wing. This is that gamma we've been talking about. The short gamma, by the way, not the long gamma. The short gamma and short vega of the SEP OpEx, structured product and put position. I want to be clear. Big koi OpExes are not more bullish or more bearish. The expected value of the distribution is the same, but the shape is very different. It is right distributed with a fat left tail.